Welcome to Invest Giant. Learn, invest, build your net worth. It's time to talk about the secret sauce of financial success. You work hard for your money, right? So why not make your money work hard for you? That's what a smart investment strategy does. I'm talking about bonds, baby. So buckle up because we're about to dive deep into the world of bonds. We'll uncover the best strategies, the insider tips, and the golden rules that'll have your portfolio purring like a well-oiled machine. Are you ready? Let's get this show on the road. Alright, let's start with the basics. Bonds might seem complicated, but they're actually quite straightforward once you get the hang of it. What the heck is a bond anyway? It's a question many people have when they first dive into the world of finance. In simple terms, a bond is like an IOU. It's a promise to pay back the money you lend, with a little extra for your trouble. When you buy a bond, you're basically lending money to someone. Could be the government, a company, or even your local city. It's a way for these entities to raise funds for various projects and operations. And just like when you lend money to your buddy, you expect to get paid back with interest. This interest is what makes bonds an attractive investment. That's the beauty of bonds. They're all about steady, reliable returns. Unlike stocks, which can be volatile, bonds offer a more predictable income stream. Now, bonds come in all shapes and sizes. There's a bond for almost every type of investor out there. You've got your government bonds, corporate bonds, which are issued by companies, municipal bonds, which are issued by local governments, and more. Each serves a different purpose and has different levels of risk and return. Each type has its own quirks and perks, but they all share that same basic DNA. You lend money, you get paid back with interest. It's a simple yet effective way to grow your wealth over time. One of the best things about bonds is that they're like the responsible older sibling in your investment family. They provide stability and security. They're not going to make you a millionaire overnight, but they're also not likely to leave you high and dry when the market takes a nosedive. This makes them a great option for risk-averse investors. So, whether you're just starting out or you're a seasoned investor, understanding bonds is key to your financial success. They can be a cornerstone of a well-diversified investment portfolio. Let's talk about the big kahuna of the bond world, government bonds. These bad boys are issued by the federal government and they're considered the safest investment you can make. Why? Because they're backed by the full faith and credit of the United States government. In other words, unless Uncle Sam goes belly up, you're guaranteed to get your money back. Now, government bonds come in a few different flavors. You've got your treasury bills, T-bills, for short-term investments, treasury notes for medium-term, and treasury bonds for long-term. Each has its place, depending on your financial goals and how long you want to tie up your money. Here's the deal with government bonds. They're not going to make you rich overnight. The returns are typically lower than other types of investments. But that's the trade-off for safety. Government bonds can play a crucial role in your portfolio. They're great for balancing out riskier investments, providing a steady stream of income, and giving you peace of mind. Now let's shift gears and talk about corporate bonds. These are like the cool cousins of government bonds. They're a bit edgier, a bit riskier, but they also offer the potential for higher returns. When you buy a corporate bond, you're essentially lending money to a company. It could be a household name like Apple or Amazon, or it could be a smaller company you've never heard of. The big draw of corporate bonds is the yield. Generally speaking, they offer higher interest rates than government bonds. Why? Because there's more risk involved. Unlike the government, companies can and do go bankrupt. But don't let that scare you off. Many corporate bonds, especially those from large, stable companies, are still considered relatively safe investments. Corporate bonds come in different flavors too. You've got your investment-grade bonds from top-tier companies, which are considered safer but offer lower yields. Then you've got your high-yield bonds, also known as junk bonds, from less stable companies. These offer higher returns but come with more risk. Section 5, Municipal Bonds, Investing in Your Community. Alright folks, let's talk about the unsung heroes of the bond world. Municipal bonds, or munis as we like to call them in the biz. These are bonds issued by state and local governments to fund public projects. We're talking schools, highways, hospitals, the stuff that makes your community tick. When you buy a muni, you're not just investing in a bond, you're investing in your own backyard. Now here's where munis get really interesting. They often come with a sweet tax advantage. In many cases, the interest you earn from municipal bonds is exempt from federal income tax. And if you buy bonds issued by your own state, you might dodge state and local taxes too. Of course, always check with your tax advisor because tax laws can be trickier than a game of three-card Monte. But tax benefits aren't the only reason to love munis. They're also generally considered pretty safe investments. Section 6. The steady income stream. Now let's talk about one of the biggest perks of bond investing, that sweet, sweet income stream. Unlike stocks, which may or may not pay dividends, bonds are all about regular payouts. When you buy a bond, you're signing up for a series of interest payments, usually made twice a year. This steady income is what makes bonds a favorite among retirees and anyone looking for reliable cash flow. Imagine knowing exactly how much money is coming your way and when. This certainty can bring a sense of peace and stability. This predictability can be a game changer when it comes to budgeting and planning for the future. It allows you to make informed financial decisions. Whether you're saving for a big purchase, planning a vacation, or just want to supplement your regular income, bonds can be your financial BFF. But here's where it gets really interesting. You can reinvest that income to turbocharge your returns. It's called compound interest, and it's like financial magic. The power of compounding can significantly boost your wealth over time. Instead of pocketing your interest payments, you use them to buy more bonds. This strategy can accelerate your financial growth. Those new bonds then generate their own interest, and so on. It's a continuous cycle of growth. It's like a snowball rolling down a hill, getting bigger and bigger. The momentum builds up over time. Before you know it, your initial investment has grown into a serious chunk of change. This is the power of a steady income stream from bonds. Section 7. Diversification. Don't put all your eggs in one basket. Listen up, because this is important. Diversification is the name of the game in investing. In the world of bonds, this means spreading your money across different types of bonds, different issuers, and different maturities. Why is diversification so crucial? Because it helps manage risk. Let's say you put all your money in bonds from one company and that company hits hard times. Suddenly, your entire investment is in jeopardy. But if you spread your money across different bonds, the impact of any single bond underperforming is lessened. Now, diversification in the bond world isn't just about buying different types of bonds. It's also about laddering your maturities. This means buying bonds that mature at different times. Some might mature in a year, others in 5 years, and some in 10 years or more. Laddering your bond maturities gives you flexibility. As shorter-term bonds mature, you can reinvest at the current interest rates. Section 8. Playing it safe. Bonds versus stocks. Alright, let's address the elephant in the room. Bonds versus stocks. It's like the investing world's version of Batman versus Superman, except in this case, both can be heroes in your portfolio. Now, I know stocks often get all the glory. They're flashy, they're exciting, and when they're good, they're really good. Stocks can make headlines with their rapid gains and dramatic losses. But bonds? They're the unsung heroes. The steady eddies that keep your financial ship sailing smooth, even when the stock market seas get choppy. They might not make the news, but they play a crucial role. Here's the deal. Stocks offer the potential for higher returns, but they come with higher risk. It's like riding a roller coaster, thrilling but with plenty of ups and downs. You need a strong stomach to handle the volatility. Bonds, on the other hand, are more like a gentle carousel ride. The excitement level might be lower, but so is the risk of losing your lunch. They provide a sense of security and predictability. In financial terms, this means bonds typically offer lower returns than stocks, but they also provide more stability and predictability. They are less likely to fluctuate wildly. But here's where it gets interesting. Bonds can actually help you stomach the volatility of stocks. How? By providing a cushion in your portfolio. They act as a buffer against the unpredictable nature of stocks. When the stock market takes a nosedive, bonds often hold steady or even increase in value as investors flee to safety. This balance can be crucial for long-term financial health. Section 9. Strategies for bond success. Alright folks, it's time to get down to brass tacks. We've covered the what and why of bonds. Now let's talk about the how. How do you build a winning bond strategy? Well, buckle up because I'm about to drop some knowledge bombs that'll have you investing like a pro in no time. First things first, know your goals. Are you investing for income, for growth, to preserve capital? Your goals will dictate your strategy. If you're all about that steady income stream, you might focus on high-quality corporate bonds or municipal bonds. If capital preservation is your game, Treasury bonds might be your best bet. It's like choosing the right tool for the job. You wouldn't use a hammer to paint a wall, would you? Next up, pay attention to interest rates. In the bond world, interest rates are like the weather. They affect everything. When rates go up, bond prices typically go down, and vice versa. But don't let that scare you off. A smart investor can use this to their advantage. Happy investing.